Distinguished guests, ladies and gentlemen, in Benin, Burkina Faso, Cote d'Ivoire, Japan, Kenya, Madagascar, Mauritania, Senegal, Tanzania, and Uganda. It is my pleasure to welcome you to this distance learning course on Islamic finance, which is being offered through the Global Development Learning Network. I'd like to thank the African Association of Distance Learning Centers and the Tokyo Development Learning Center for their initiative in organizing this important program, which is the first ever GDLN offering on the topic of Islamic finance. While Islamic finance still remains relatively small as a percentage of total global financial activity, it has experienced rapid growth over the past 2 decades, with total assets rising from about $5 billion in the late 1980s to roughly $1.3 trillion in 2011. Moreover, Islamic finance is playing an increasingly important role in supporting sustained economic development and growth through 3 main channels. First, Islamic finance is boosting financial intermediation, which is so important for development. By channeling savings to investment, financial intermediaries help to ensure that individuals, households, and firms have access to the credit and capital needed to improve economic performance. However, it is evident that as compared to countries and populations that rely primarily on conventional finance, there is a long way to go towards ensuring that populations that prefer Islamic finance have adequate access to markets and institutions serving this purpose. Expanded offerings from Islamic finance institutions are helping to fill this gap. In addition, 10 major international conventional financial institutions have opened Islamic finance windows in recent years. This translates into Islamic finance products potentially being available in an additional 44,000 outlets and branches across more than 70 countries around the globe. As a result of the expansion in Sharia-based assets, Islamic finance is helping to address the challenge of financial inclusion, which is the second channel, and an issue that is gaining increasing importance in the global development agenda today. Data from new Global Financial Inclusion Index, launched recently by the World Bank, demonstrates why this issue is so important. The index measures usage of financial products and services across countries and over time, based on demand-side indicators. Its coverage includes 148 countries. The picture that emerges from the index is quite sobering. It suggests that some 2.5 billion people worldwide, including about 75% of the world's poor, are unbanked and thus face the challenge of adjusting to adversity and shocks without the benefit of access to financial services. For a given level of per capita income, initial analysis of the data suggests that the issue is prevailing in majority Muslim countries. Islamic finance has an important role to play by delivering products and services that correspond to local customs and norms and which meet the needs of populations that have been underserved by conventional financial institutions. A sector that warrants particular attention is Islamic microfinance. Despite the recognition of the importance and positive impact of microfinance as an instrument for boosting financial inclusion and expanding the reach of financial services to the poor, it is estimated that only 300,000 clients worldwide are being served by Islamic microfinance institutions, with the services heavily concentrated in only a few countries, most notably Bangladesh, Indonesia, and Malaysia. Unlocking the potential of Islamic microfinance could have a huge impact on enhancing financial inclusion in countries in Africa and the Middle East. A similar impact could be supported by harnessing new technology, most notably mobile phones, to offer Islamic banking. The third way in which Islamic finance can contribute to economic development is by enhancing financial stability. Recent empirical work suggests that Islamic financial institutions have fared much better than conventional counterparts in weathering the financial crisis that gripped the world starting in 2008. This ability to respond well to shocks is the result of several features and principles of Islamic finance, including higher rates of capitalization of Islamic banks, absence of pure debt securities, collection of bank deposits on a profit and loss sharing principle rather than fixed liability basis, affirmation of property rights and contract enforcement, emphasis on principles of morality and ethics in business conduct, advocacy of sharing of risks and rewards between the rich and the poor. I believe that prospects for growth in Islamic finance are bright. Quality is improving, with new instruments being developed and Islamic finance offering practical alternatives to conventional finance across a range of products, including credit cards and housing finance. Moreover, reputable global financial institutions are doing their homework to take advantage of this fast-growing business and are in turn catalyzing the growth of the industry. However, the industry is confronted by a number of challenges that need attention. The key areas include improving regulatory oversight. A second issue of concern is the rebalancing of tax treatment. A third is strengthening insolvency frameworks. The fourth is promoting standardization of financial products. The fifth is ensuring adequate liquidity for long-term financing. The sixth is establishing sound risk management practices. I'm pleased to highlight that several of these challenges will be covered in this distance learning course. The World Bank is very much engaged on the Islamic finance agenda in a number of ways, including the World Bank is joining other MDBs, other multinational development banks and institutions in tapping Islamic financial markets. For instance, the IFC, which is the private sector arm of the World Bank Group, had recently significant transactions based on Islamic law and Sharia. MIGA and the World Bank Treasury, both of them had transactions recently as well based on Islamic finance. Supporting the development of corporate governance frameworks, insolvency mechanisms, and compliance and regulations is another way of participating in the growth of the industry. Participating in knowledge sharing and capacity building is another way as well of engagement in this growing industry. In this context, the World Bank is very pleased to be able to support the development and delivery of this course. I believe that initiatives such as this, which promote knowledge exchange among academics, policymakers, and practitioners, will help to improve awareness and understanding of Islamic finance and of the important role that it can play in ensuring that individuals, households, and firms in developing countries have access to a wider range of financial instruments and to finance required for the promotion of growth and sustainable development. I wish you all every success in this course and hope that it will underpin your efforts towards enhancing the availability and quality of Islamic finance products and services in your countries.